Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. In today's video, we are going to be talking about a highly effective 30 minutes Forex strategy that can help you capture key market moves without spending all day in front of your screen. Whether you are looking for a trade during your lunch break or you want to have a more efficient way to approach the market, this trading strategy offers the perfect balance between time and profitability. Make sure you watch until the end of this video as we will break down each step of the process, from identifying trends to managing risks, and even show you a live example of how this strategy works. So let's get started. I'm sure you might be wondering why we use the 30 minutes time frame. Why the 30 minutes time frame stands out among all other trading intervals. Let's break this down. The key advantage that makes this time frame particularly powerful for consistent trading success is because it provides a balance between capturing meaningful price movement and filtering out the noise, unlike shorter time frames that can trigger false signals or longer ones that might make you miss out important opportunity. The 30 minutes chart gives you a clear picture of the market direction. As you can see from the chart, you can see this is the 30 minutes time frame and it is giving you a clear picture of what the market is doing in real time. As you can see, we can from this timetable tell you that the market is trending towards the downside. So the 30 minutes time frame is a clear time frame that shows you exactly what price is doing in real time without false signals. If you can note how the price movement on this chart shows clear patterns without excessive noise, you will see on the 15 minutes time frame, or you see on the 5 minutes or the 1 minute. This clarity helps you make more informed trading decisions with great confidence. The 30 minutes time frame also aligns perfectly with market sections, the major market sections. You can effectively trade during the London, New York session overlap when market volatility is at its peak without being glued to your screen for hours. Remember, successful trading isn't about watching the chart all day. It is about making smart and calculated decisions when the right opportunity presents itself. The 30 minutes time frame gives you exactly that advantage. Now let's look at a step-by-step trading strategy. Let's look at how we can take a trade using this strategy. Let's break down the 30 minutes trading strategy into a clear and actionable step that you can implement right away. So pay close attention as each step builds upon the previous one and creates a robust trading system. First of all, we start by identifying the trend. Now, as we will start by analyzing the overall market direction using two moving averages, which is the 20 EMA and the 50 EMA, as you can see from my screen. The 20 EMA and the 50 EMA. When the 20 EMA crosses above when the 20 EMA crosses above the 50 EMA, is a sign that we are expecting potential upside. When the 20 EMA crosses below the 50 EMA, it shows that we are expecting possible downside or downtrend. It's as easy as that. So this is an example, as you can see from the screen. The crossover provides a clear signal for potential trade setup. So we have to wait for a crossover first to be completed before considering any trade. Now the second step is to confirm the market momentum. Once you have identified the trend, you would use your RSI indicator. As you can see on my screen, this is the RSI indicator. We use it to look for readings above the 20, the 60% in an uptrend and 40 in a downtrend. So the readings, when it's above 60, it shows that, let's look for a bullish example. When it's above 60, as you can see from my screen, this is 60 and above. It shows that yes, we are really expecting an uptrend. Then when it's below 40, when it's below 40, it shows that yes, we are expecting a downtrend. Now, how do we enter? We can enter a long position when price pulls back to the 20 EMA. As you can see, we first got our crossover at this area. The 20 EMA crossed above the 50, and it shows that yes, it's time for us to take a bullish setup. We look at our RSI, and our RSI is trading above the 60 hour mark. What we need to do is to wait for price to pull back to the 20 EMA before we take our trade. When price got to this area, we enter our long position. Let's not forget our risk management. We put our stop loss below a support or a previous swing low. If we can go back in time, we will find out that this area is an area of importance. Look at, price has been rejecting around this area, which shows that yes, there is a support or a resistance around this area. So yes, when we take the trade, we'll put our stop loss below. In case of a long position, we put our stop loss below the previous swing low. We can put it 20 pips below or 10 pips, or just give it breathing space. Then let's not forget our take profit. Our take profit has to be set at a minimum of 1:2 risk to reward ratio. Let's not also forget that we don't have to be greedy. If we can get 1:2, it is okay. Remember, proper positioning size is crucial. Never risk more than 1 to 2% of your trading account on a single trade, because this is to ensure you can withstand series of losses without significantly impacting your trading capital. By following this step-by-step rules, you can systematically create a structural approach to your trading that can remove emotional decisions and help you maintain consistency in your trading results. Now let's look at an example of a bearish trade that we can take. First of all, we start by identifying the trend by looking at where the RSI, the EMA, the 20 EMA trades below the 50 EMA. As you can see here, the 20 EMA, which is the red line, trades below the 50 EMA, shows us yes, this is a signal for lower prices. We look at our RSI and we can see that yes, price is really trading below the 40%. It's really moving below the 40 area. Then we wait for price to get to the 20 EMA before we take our short position. When price gets to the area, we take the short position, and don't forget, you have to put your stop loss above an area of resistance, or you put it above a swing high or a swing low. 10 pips above or 15, as the case may be, just to give yourself enough breathing space. Then don't forget your take profit should be 1:2, 1:3, or a previous swing low, just to be comfortable with your trade. And by by the time we are done with this trade, you can see it smashed our take profit. As easy as that. Don't forget the confluence. You have to first of all wait for the 20 EMA to trade below or above the 50 EMA. We have to check our RSI to see if it's trading above the 60 or below the 40. Then we wait for price to get back to the 20 EMA before we take our trade. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you will never miss out on any of our trading tips or strategy. Thank you for watching, and we will see you in the next video. Peace.